Welcome to the deep dive. We've got quite a stack of recent news and analysis here today.
Yeah, it looks like a busy one.
It really is. We're
Mm.
covering everything from, market movements and economic trends to some big corporate announcements in tech, health, media.
And some pretty significant policy stuff coming out of Washington too, right?
Exactly. It's quite a mix. Seems like everything's connected right now, doesn't it?
It really does. Global trade talks impacting local jobs, tech investments, changing energy policy. It's all woven together.
Absolutely. So our mission, like always, is to unpack all this for you. We want to pull out the key insights, maybe some surprising facts, and really try to figure out what it all means for your world.
Sounds good. Where should we start?
Okay, let's dive in. We'll kick off with the economic pulse. The markets have been making some moves lately. The S&P 500 just closed above 6,000, first time since February.
Yeah, that's a big number.
Yeah.
And the NASDAQ composite is seeing gains too.
Right. So what's driving this?
Well, one interesting idea floating around is that big money, the large institutional investors might finally be turning bullish.
Oh, really? How do we know that?
There's this institutional investor risk appetite index from State Street, and it's showing that these big players are now embracing the rally, not just sort of cautiously dipping their toes in.
Embracing it. So does that mean things could keep going up?
It suggests we could potentially see what they call a melt-up. That's market jargon, basically a rapid upward move driven more by sentiment and momentum, maybe heading into the quarter end.
A melt-up, okay. But I've also heard people talking about the market hitting the summer doldrums. Is that still a thing?
It is, yeah. That's a seasonal pattern some commentators are pointing to. Summer months historically can have lower trading volume.
But does lower volume always mean lower prices?
Not necessarily, no. So you've got this kind of tension, institutional enthusiasm, maybe pushing things higher, butting up against this expectation of summer quietness. It's one of those conflicting signals we're seeing a lot of right now.
Speaking of conflicting signals, recession expectations. Those seem to have shifted, like, dramatically.
They really have. There was a recent survey, and it showed a really sharp drop in the number of CEOs expecting a recession.
How sharp.
Less than 30% now see a mild or severe recession in the next 6 months.
Wow, less than 30. Because like back in April, wasn't it way higher? Like over 60% were worried?
Exactly. Over 60% were bracing for one then. It's a huge swing.
So what changed between April and now? What eased their minds?
It seems directly linked to how things unfolded with President Trump's tariff announcements. Remember those initial really broad and steep levies announced around April 2nd?
Yeah, that definitely spooked people.
Right. That caused that spike in fear among business leaders. But then there was that partial rollback, the pause shortly after.
Right.
And that seems to have significantly eased those immediate concerns.
Okay, so fewer tariff fears means fewer recession fears, at least for many CEOs.
Yeah.
But is the idea of stagflation still lurking? That nasty mix of slow growth and sticky inflation?
It definitely is. Some market watchers are still wondering if that could be where we end up. And if you look at certain data points, well, they suggest things aren't exactly firing on all cylinders everywhere, like the job market.
Right. What's the latest on the job market?
Well, the data showed over 7 million Americans were unemployed in May.
7 million. How does that stack up historically if we ignore the whole pandemic chaos?
If you exclude the pandemic years, that's actually the highest number since 2017.
Really? So what does that tell us?
It suggests that even if the main unemployment rate looks decent, finding a job is harder for a lot of people right now. It hints at maybe a more chaotic or uneven labor market than the headline numbers always show.
Okay, so maybe less immediate recession risk, but still some underlying weakness.
Yeah.
What about inflation, though? I saw the New York Fed survey had some positive news.
Yes, it did. That survey showed a pretty substantial dip in what people expect inflation to be over the next year. It dropped to 3.2% in May, down from 3.6% in April.
Okay, that's a noticeable drop.
And longer-term expectations also edged down a little bit.
And the timing. Did that dip happen around the same time President Trump eased up on some of those tariff threats again?
Exactly. And administration officials are really jumping on this. They're arguing that tariff revenue is going up while inflation expectations are coming down.
So they're saying, see, tariffs aren't automatically inflationary like everyone claims.
Right. They're saying it's contrary to the story that everybody else has been saying, but very consistent with what we've been saying, pushing back hard.
Did that NY Fed survey have any other good news?
Yeah, a couple other points. The number of people worried about missing a debt payment actually fell to its lowest since January. And consumer confidence specifically about the stock market went up.
Okay, but hold on. That feels confusing because you hear firms on their earnings calls still sounding the alarm about tariffs potentially hitting their profits and that they might have to pass those costs on, which could make consumers pull back. And then you see other data, like the University of Michigan Consumer Sentiment Index, plunging near record lows. How did that square with the NY Fed data?
It doesn't really square easily, does it? It's definitely a messy, conflicting picture. You've got different surveys asking different things, businesses worried about costs, consumers feeling maybe slightly better about inflation expectations, but still worried about their overall situation.
It just highlights the uncertainty.
Absolutely. And I saw one trader's take that kind of captured this mood. They suggested stocks could actually keep doing okay for months, despite all this inflation uncertainty.
Meaning the market basically admits it doesn't know the path for inflation any better than the Fed does, but it's stable enough for now.
Precisely. It's like the market is saying, we're as clueless as the Fed, but we can live with that for a while, trying to adapt amid the unknowns.
That leads us nicely into policy and trade, because those tariffs are clearly a huge factor in everything from CEO mood to inflation hopes. That April 2nd Liberation Day tariff announcement really caused some waves initially, didn't it?
Oh, absolutely. It was pretty abrupt. And one source pointed to a specific early victim, the luxury home furnishings retailer RH.
What happened there?
Their shares dropped sharply right after they put out a weak outlook that afternoon, and they directly linked it to worries about how those first broader tariffs would hit them.
Okay, so Trump announced them, markets reacted, then he paused many of them, setting up this negotiating window that expires in July. What's the latest on the negotiations?
Well, a key development is happening right now, today and tomorrow. U.S. and China trade officials are actually holding talks in London.
In London. Okay, what's the main goal for the U.S. side in these talks, based on what we're seeing?
The reporting suggests a very specific objective, getting China to restore exports of critical minerals.
The rare earths and things like that.
Exactly. U.S. officials are apparently looking for a big, strong handshake, that's the quote, to get this issue behind us. And in return, the idea is the U.S. might ease some of its own export controls on rare earths going to China.
Those minerals are so vital for tech, for defense. What are the experts saying about the chances of a deal here?
Well, just like the economic outlook, the views are divided. One expert sees this as a big test of the theory that China's economy might be weaker than it looks, basically. Are they under enough pressure to make concessions?
And the other side?
Another expert thinks China is actually in a quite strong position, economically speaking, and can still play that rare earth card, which, in their view, makes the U.S. feel desperate for a resolution.
So very different takes on who has the leverage, especially since tariffs did get really high, up to 145% on some Chinese goods after China hit back in April.
Exactly. It highlights just how much is riding on these talks and how differently the situation is being read. High stakes.
Definitely. Okay, let's shift gears a bit to another major policy piece. President Trump's proposed Big Beautiful Bill. There's quite a bit of critique in the sources we looked at, questioning whether it will actually deliver the economic boom he's promising.
Yeah, that critique is pretty detailed. The core argument from that perspective is that the bill, as it stands now, is unlikely to spark that kind of broad economic surge.
Why not? What's the reasoning?
Well, the main point is that it largely just extends the existing tax rates from the 2017 law. There aren't major additional tax cuts, like another big cut to the corporate tax rate. The phrase used in the analysis was no change, no gain.
Okay, and they even raised questions about the tax cuts that are in there, like eliminating taxes on tips or overtime.
Right. The critique suggests that while cutting taxes on tips, overtime, maybe even Social Security benefits sounds appealing,
Hmm.
it could actually give employers an excuse to pay lower base wages in those areas, effectively canceling out the tax benefit for the worker.
Interesting point. So, according to this analysis, there's not much in the bill that would genuinely speed up economic growth.
That's the view presented, yes. And they raise really significant concerns about the debt. The projections show this bill adding somewhere between $2.4 trillion and $3.3 trillion to the budget deficit over the next 10 years.
Wow. With the national debt already sitting at, what, $36.2 trillion? Adding trillions more is, well, it's a lot.
It is, and the critique argues that needing to borrow even more could push up interest costs for everyone as investors start getting nervous about the U.S. fiscal situation.
Does the critique mention any other potential drags?
Yeah, it also points out that reductions in support programs for lower-income Americans, like Medicaid and food stamps, are apparently embedded in the bill. The analysis suggests this could actually slow things down, hitting those who can least afford it, and that proposed spending cuts in areas like technology, medicine, and education could hurt U.S. competitiveness and growth in the long run.
And the sources even used a historical comparison to make their point, didn't they?
They did. They brought up the Clinton administration. The point made was that during that era, tax rates were higher, but annual economic growth was actually stronger, nearly 4% a year.
And job growth, too.
Significantly more jobs added per month. Yeah, over 240,000 back then, compared to President Trump's pre-pandemic average, which was under 200,000. And crucially, the budget deficit turned into a surplus under Clinton.
So the conclusion from that analysis is pretty stark.
It is. It basically says current policies aren't set up for that kind of Clinton-era growth, and this bill would need big, bountiful changes, their words, to bring prosperity beyond, as they put it, a handful of billionaires. Again, that's one strong perspective presented in the source material.
A very pointed critique. Okay, let's move from the macro policy view to what's happening in the corporate world. Lots going on there, too, starting with some really massive infrastructure news involving Amazon.
Yeah, this is huge. Amazon is pouring $20 billion into building 2 massive data center complexes in Pennsylvania.
$20 billion, that's serious money. What's driving that?
It's all about the absolutely explosive demand for cloud computing, and especially for artificial intelligence infrastructure. AI just consumes enormous amounts of power and data capacity.
And there's a really intriguing detail about where one of these is being built, right?
There is, yeah. It gets kind of surprising. One of these giant data centers is going up right next door to the Susquehanna nuclear power plant.
Right next to a nuke plant. Why there? That seems direct.
It's what they call a behind-the-meter setup. The idea is to plug the data center directly into the power plant's output before that electricity even hits the main power grid.
Why do that? What's the advantage?
It can mean faster, potentially more reliable power access, and it might let them bypass the congestion and maybe some of the costs associated with connecting to the regular grid, which can be strained in some areas.
So they bought a facility right there.
Exactly. Amazon actually acquired an existing data center facility from Talon Energy, which is a majority owner of the nuclear plant, for $650 million. The goal is to secure 960 megawatts of power directly from the plant.
960 megawatts. Just for one data center complex. How much is that in context?
It's about 40% of the total output of one of the nation's largest nuclear power plants, just for Amazon's data centers at that site.
Wow. That really puts the energy hunger of AI into perspective. But this whole behind-the-meter plan isn't smooth sailing, is it? It's facing some hurdles.
It is. The arrangement is currently being held up by FERC, the Federal Energy Regulatory Commission. They're the ones who oversee interstate electricity transmission.
And why are they holding it up? What's the issue?
Well, this is reportedly the first time FERC has dealt with a behind-the-meter deal of this specific kind and scale, involving a data center tapping directly into a major power plant like this. And it's raising some big questions for them.
Like what kind of questions?
Like, is it fair to let these huge data centers essentially claim massive amounts of power directly from the source, potentially diverting it from the general grid? And should these big power users be excused from paying some of the costs of maintaining that shared grid infrastructure that everyone else depends on? It's a tricky new regulatory challenge driven by this tech boom.
It really shows how AI isn't just about software and chips. It's fundamentally reshaping energy needs and policy. Did the sources mention other similar projects in Pennsylvania?
They did, yeah. It seems to be a bit of a trend there, maybe because of the existing power infrastructure. There's talk of a deal involving the owner of the former 3 Mile Island nuclear plant potentially restarting a reactor there just to power data centers.
Wow, restarting a reactor.
Potentially. And another plan involves converting a large former coal-fired power plant into a campus powered by natural gas, also for data centers. Companies are clearly getting creative, leveraging these existing energy sites to meet this massive new demand.
Okay, speaking of AI drivers, NVIDIA's CEO, Jensen Huang, was apparently treated like a rock star at London Tech Week recently.
Yeah, rockstar treatment is right. They were calling him the godfather of AI, even comparing him to Iron Man. He's definitely seen as a central figure right now.
And he's still very bullish on AI.
Incredibly so. He keeps talking about AI not just as a product, but as fundamental infrastructure like electricity was, something that will change everything.
And it sounds like his visit was a pretty big win for the UK specifically.
It seems so, yes. He was very complimentary, calling the UK the envy of the world for its AI environment, saying it has a Goldilocks circumstance, sort of just right for innovation.
Did he announce anything concrete?
He did. NVIDIA announced plans to partner more closely with the UK government, support a new UK sovereign AI industry forum, and detailed deals with some UK-based companies like Netscale and Nebius to deploy NVIDIA's latest and greatest GPU chips, the Blackwell series. London was actually the first stop on his European tour, which signals its importance in their eyes.
Interesting. Okay, so from NVIDIA, which is riding the AI wave high, let's turn to Apple. Their big Worldwide Developers Conference, WWDC, had its keynote today. And this felt like a pretty important moment for them, right? Their stock has been lagging.
Yeah, definitely. Apple's stock is down over 18% this year, really missing out on that AI-fueled rally that's lifted many of its peers. So, yeah, a lot of eyes were on this keynote, especially looking for their big AI play.
So what do they announce? Let's run through some of the highlights mentioned in the sources. They're changing the operating system names.
Yeah, simplifying things. It's just going to be 26 now, so iOS 26, macOS 26, watchOS 26, and so on. Trying to streamline it.
Okay. And a big visual redesign for iOS.
Looks like it, yeah. The first major overhaul visually since way back in 2013. They're calling the new look Liquid Glass, and it seems heavily inspired by the interface on their Vision Pro headset.
And the Mac gets a new OS name, too.
Yep, the new macOS is called Tahoe. It's getting features like a transparent menu bar, more customization with folder colors, you can use emojis and file names now, better integration with the Shortcuts app, things like that.
What about the Vision Pro itself? Any updates for the headset?
Quite a few, actually. They're boosting the gaming side, adding support for Sony's PlayStation VR2 Sense controllers, which is interesting.
Yeah.
They also announced partnerships with camera makers like Canon, GoPro, and Insta360s, so video shot on those devices will play back more naturally in the Vision Pro environment.
Makes sense. Anything for work or collaboration?
Yeah, some enterprise features. You can now pull 3D objects directly from websites into your virtual space. There's a new For Your Eyes Only mode for screen privacy when others are around, and integrations with tools like a Logitech drawing stylus called Muse.
And can multiple people use them together now?
That was a notable announcement, yes, enabling multiple people wearing headsets to interact within the same shared virtual space. Seems like a step towards more collaborative uses. They also showed off new virtual items you can place in your room, like persistent virtual clocks or extra windows.
Any fun updates for other devices?
A few, yeah. Apple TV is getting a karaoke feature that can apparently turn down the original vocals in songs and let you use your iPhone as the microphone.
Oh, okay.
Apple Music gets things like lyrics translation, an AI-powered DJ feature called AutoMix, and pinning favorites. There's also a brand new Games app coming, meant to be a central hub for all your games, adding social stuff like friend lists, challenges, leaderboards.
And CarPlay. Big changes there, too.
Significant updates mentioned, yeah. A new widget-based interface and design changes for how calls look and work in the car.
All right, let's get to the main event, the AI integration. This was the big question mark. They talked about visual intelligence.
Yes. This seems to use the iPhone's camera and processing to understand what's on your screen or what you're looking at. They showed an example where an Ask button pops up, and you could use it to query, say, ChatGPT about the content, maybe finding similar clothes to what someone's wearing in a photo.
Okay, so that confirms the partnership everyone was expecting. Apple is using OpenAI's ChatGPT to power some of these new features, specifically enhancing their Image Playground app.
That's right. The example given was describing a visual style you want for someone in your contacts list, and the ChatGPT assistant helps generate or adjust the image accordingly.
How are they handling privacy with OpenAI involved?
Apple made a big point about privacy here. They stress that nothing is shared with OpenAI servers without your explicit permission first. And it's also worth noting, these new Apple Intelligence features, as they're calling them, won't work on all iPhones. They require specific newer models, the latest iOS version, and they won't be available everywhere or in every language right away.
Okay, so a phased rollout and hardware requirements. What was the immediate reaction from analysts to all this, especially the AI stuff? Was it the big splash they needed?
The reaction seems a bit mixed, maybe even underwhelming for some who were hoping for more. One well-known Apple bull actually called the keynote a yawner.
A yawner. Ouch.
Yeah. His take was that Apple laid out a kind of vision, but it was void of any major Apple intelligence progress. The feeling seems to be that Apple is maybe playing it safe here.
Playing it safe. What does that mean in this context?
Well, this analyst suggested Apple might actually need to make some bigger AI acquisitions to jumpstart this AI strategy. He sees a tight window for Apple to really establish itself in AI, and that uncertainty is clearly still weighing on the stock.
A tight window.
Yeah.
That pressure in the AI space is intense right now.
Yeah.
Okay, shifting gears again to another big media company making changes. Warner Bros. Discovery. They're planning a split.
Yes, a pretty major restructuring. They plan to split into two separate publicly traded companies by the middle of 2026.
Two companies. What will they be?
One will be focused purely on streaming and the studio business. Think Max, HBO, Warner Bros. Films. The other will contain the global networks, the traditional cable channels like CNN, Discovery Channel, TNT, etc.
What's the strategy behind splitting them up like that?
It seems aimed squarely at competing better in the streaming wars. The thinking is to free up the streaming and studio side, which they see as the future growth engine from being financially dragged down by the declining traditional cable networks business.
So separate the growth part from the legacy part. What happens to the networks company's connection to streaming?
The global networks company will actually hold on to a stake, up to 20%, in the new streaming and studios business. The plan is apparently to sell off that stake over time to help pay down Warner Bros. Discovery's pretty significant debt load.
Okay, makes sense. Let's jump over to healthcare now. Big news on the RSV front. The FDA approved a new shot from Merck for infants.
Yes, this is important. It's called Influenza, and it's designed to protect infants from respiratory syncytial virus, or RSV, and it creates direct competition for the shot that came out last year, Beyfortus, which is from Sanofi and AstraZeneca.
So now there are two options for infants. How do they compare?
Well, Merck says they expect to start taking orders for Influenza in July, getting ready for the fall and winter RSV season. You might remember Beyfortus had some supply issues last season, so having another option could be really helpful.
Are they the same type of shot?
They're both preventative monoclonal antibodies, so basically lab-made antibodies that help the baby's immune system fight off the virus, but they actually target slightly different parts of the RSV virus.
Any other key differences?
One difference Merck is highlighting is the dosing. They say Influenza has weight-agnostic dosing, meaning it's the same dose for all infants, regardless of their weight, which they argue is more convenient for doctors. Beyfortus, on the other hand, has dosing based on the baby's weight.
And Sanofi is working on supply for Beyfortus.
Yes, Sanofi has said they're increasing their supply for the upcoming season, so hopefully availability will be better overall.
And just to clarify, these are different from the RSV vaccines for adults, right?
Correct. There are other approved RSV vaccines, but those are for older adults or sometimes pregnant women to pass immunity to their babies. Testing of vaccines directly in young children was actually paused recently by the FDA due to some unrelated safety concerns that came up in trials.
So what's the next step for these infant shots?
The CDC's advisory committee is scheduled to meet June 25th to 27th. They'll review the data and make official recommendations on how these shots should be used for infants this season.
Got it. Okay, before we leave the corporate world, let's quickly hit a few other stock movers mentioned in the sources today. Topgolf Callaway brands jumped.
Yeah, significantly. That was reportedly after one of the company directors bought about $2.5 million worth of the stock.
Insider buying. That's usually seen as a good sign, right?
Yeah. Often, yes. It suggests someone with inside knowledge has confidence in the company's future, especially since, as the source noted, the stock itself has performed poorly lately, down over 50% in the past year, so that buy got attention.
Okay. Universal Health Services, on the other hand, fell.
Yes. That was linked to reports that they're seeing lower volumes of medical procedures being done, and their CFO also apparently raised concerns about how President Trump's proposed spending bill, the big beautiful bill we talked about, could potentially impact hospitals financially.
Right, connecting back to policy. What about eToro, the online broker?
They recently had their IPO, and analyst reviews were apparently mixed. But the sources did note analysts praising its platform for being user-friendly, especially for individual investors, highlighting tools like CopyTrader, which lets you mimic other traders, and Smart Portfolio, which offers themed investments.
IonQ, the quantum computing company, saw its shares rise.
That followed news they acquired a quantum computing startup based in the UK. Shows ongoing activity and consolidation in that really cutting-edge field.
And Robinhood, the trading app.
Their stock dropped. Apparently, there was some speculation they might get added to the S&P 500 index, but they were snubbed. Didn't happen. So some investors who were hoping for that boost from index funds buying were likely disappointed.
Tesla shares were down too.
Yeah, that followed an analyst downgrade. The reasons cited were uncertainty around Elon Musk's very ambitious robo-taxi plans, and also, interestingly, his increasingly public relationship and interactions with President Trump, which some analysts apparently view as a potential distraction or even a risk factor for the company.
And EchoStar, the satellite company, took a big hit.
A really big tumble, yeah. That was based on a report suggesting the company is considering filing for Chapter 11 bankruptcy protection. Obviously, that's very serious news for investors.
Wow. Okay, one positive trend mentioned, the Aerospace and Defense ETF.
Right. That sector-focused exchange-traded fund is apparently near a record winning streak. So that part of the market continues to show a lot of strength, maybe reflecting global tensions or consistent government contracts.
Okay, let's transition now into our policy deep dive. We touched on tariffs and the spending bill, but let's start with a pretty significant legal development from the Supreme Court today.
Yes, this involves access to Social Security Administration data. The court issued a decision allowing a federal agency, DOGE, temporary access to that data.
DOGE. What is that?
It stands for the Department of Government Efficiency. It's an agency the Trump administration set up specifically to root out waste, fraud, and abuse within other federal agencies. And part of their mission involves trying to get access to huge amounts of data held by the Social Security Administration, the SSA.
And there was a lawsuit challenging this access, raising some serious concerns.
There was, yes. Plaintiffs, including advocacy groups and unions, argued this was unprecedented access to incredibly sensitive personal information for millions and millions of Americans.
What kind of information are we talking about?
Things like birth dates, citizenship status, ethnicity, even health information, tax records, really a vast trove of private details.
And the lawsuit wasn't just about access, but also about how DOGE might be handling the data.
Exactly. The plaintiffs alleged that DOGE had already shared some of this data publicly, potentially making it vulnerable, and argued the whole process violated privacy protections and wasn't necessary for standard government oversight.
So, given all those concerns, what did the Supreme Court actually decide today? Is DOGE getting full access?
It was a 6-3 decision, and they sided with the administration for now. The key is temporary. The ruling allows DOGE access to the data in order for those members to do their work, but only while the underlying lawsuit continues in the lower courts.
So they get the data now, while the courts still figure out if the access itself is actually lawful in the long run.
Precisely. It allows access during the legal battle, rather than making them wait for a final decision on the legality.
And there were justices who disagreed strongly with that approach.
Yes. There was a dissent written by Justice Jackson, joined by Justice Sotomayor, and Justice Kagan also dissented separately. Jackson's dissent argued that DOGE was getting far broader data access than is typical for these kinds of investigations.
And that the government hadn't proven why they needed it right now.
Exactly. The dissent argued the government failed to show they would suffer irreparable harm, basically, that something terrible and irreversible would happen if they had to wait for the courts to fully review the privacy risks and the legality before getting immediate access. They felt the majority wasn't giving enough weight to those concerns up front.
So a split decision allowing temporary access despite significant privacy concerns raised. How did the administration react?
They framed it as a clear victory. Both the White House and the SSA put out statements calling the ruling a win for their efforts to fight waste and fraud and to modernize government systems.
Okay, let's move to another administration initiative that was highlighted today. These things called Trump accounts for newborns. President Trump was promoting them with some CEOs at the White House.
Yes, this was part of a roundtable event for a program they're calling Invest America. The core idea is a pilot program.
A pilot program for what?
For babies born in the U.S. between 2025 and 2028, the government would deposit an initial $1,000 into an investment account, likely an index fund for each eligible newborn.
$1,000 from the government to start an investment account. Can parents add more?
Yes, the plan allows for additional contributions, up to $5,000 per year into these accounts. The money would be controlled by the child's guardians until the child turns 18, then they could access it.
Where does the initial $1,000 come from?
The proposal is for that seed money to come directly from the U.S. Treasury.
And what's the status of this idea? Is it law?
It actually passed the House as part of that big, beautiful bill we discussed earlier, but according to the sources, it's facing considerable pushback in the Senate. So its future is uncertain.
And it was interesting that CEOs from some big companies were at this White House event.
Yes, definitely. CEOs from places like Dell, Uber, Goldman Sachs, Robinhood, they were all there. And the expectation mentioned is that companies like these might actually step up and collectively invest billions into these accounts for their own employees' children, perhaps as a new kind of workplace benefit.
Interesting corporate tie-in. But are these accounts necessarily the best way to save for kids compared to what's already out there?
Well, that's a point of debate. Some financial advisors quoted in the sources suggest that these proposed Trump accounts might not actually offer the best investment incentives or tax advantages compared to existing options, particularly 529 plans, which are specifically designed for education savings and have significant tax benefits.
So the White House is promoting them as life-changing, but some financial experts see potential limitations compared to current tools like 529s.
Right. It's presented as a way to get young Americans on the right financial path early, but there are questions about whether it's the most efficient vehicle compared to what already exists.
Okay, and finally, just a quick note on another area where President Trump is applying pressure, the Federal Reserve.
Yes, sources are indicating he's pressing Fed Chair Jerome Powell quite hard for an immediate full percentage point interest rate cut right
A
now.
full point. That's aggressive, especially
Mhm.
when the markets aren't expecting anything until maybe September, right?
Exactly. Trump reportedly called the current Fed policy a disaster. But despite that strong pressure from the White House, market expectations for the Fed's next meeting, which is coming up June 17th and 18th, are still very much tilted towards no rate cut at all then.
So another case of political pressure clashing with market consensus and Fed independence, potentially.
It certainly highlights the tightrope the Fed often has to walk.
Okay, wow. We have covered a lot of ground today.
We really have.
From, the stock market rally nuances, the potential melt-up versus the summer doldrums and all those conflicting economic signals.
Yeah. The falling CEO recession fears clashing with those weaker job numbers, and the lower inflation expectations butting up against ongoing tariff concerns. It's a mixed bag.
Then diving into the corporate world. Amazon's huge data center plans and the energy questions they raise, NVIDIA's ongoing AI dominance, Apple's big WWDC reveals, and the perhaps mixed reaction to their AI progress.
Plus, that major split planned for Warner Bros. Discovery and the new competition in the RSV shop market for infants.
And we wrapped up with some really significant policy developments. Those crucial U.S.-China trade talks happening now, the detailed critique we saw of the Big Beautiful Bill, that Supreme Court ruling on government access to sensitive data.
And the new Trump accounts proposal for newborns, alongside that very direct pressure being applied to the Federal Reserve on interest rates.
It really underscores how interconnected everything is, doesn't it? You can't look at the markets without thinking about trade policy or tech without thinking about energy and regulation.
Absolutely, and understanding how these pieces fit together. How trade talks in London could eventually influence prices you pay, how data access debates impact your privacy, or how new savings programs might work for families. That's really key to navigating your own financial and personal landscape these days.
It's about connecting those big headlines back to your world.
Exactly. Making sense of the noise.
So as we finish this deep dive, maybe here's a final thought for you to chew on. Just how quickly can the entire economic outlook or market sentiment really pivot based on a single policy announcement or the result of one negotiation?
Yeah, that's a great question.
And what does that kind of inherent volatility, that rapid change potential, mean for how you approach long-term planning in a world that feels increasingly interconnected and, frankly, changing faster than ever?